Good evening, everyone. Welcome to the Loan Officer Training Series with the Mortgage Calculator. Tonight, we're going to be talking about how to structure a gift of equity purchase transaction. Give us just a moment here to go live on all the different platforms. Appreciate everybody tuning in nice and early. Go ahead and drop a comment there in the chat. We got it pulled up on the screen. Great topic here for tonight. And it looks like we're live on all the platforms, so we'll go ahead and get it started. What we'll do is we'll take the chat off the screen for now, but go ahead and keep dropping your comments there in the chat. You can also drop any questions you have in the chat as well. So welcome, everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We are a lender that specializes in non-QM loans, and what we do every Tuesday, Wednesday, and Thursday evening at 7 p.m. Eastern on this show is a different loan officer training topic. And tonight we're going to be talking about gifts of equity. So Jose, I know you have a presentation, so let's go ahead and pull it up and talk about how to structure a gift of equity purchase transaction.
Good evening, everybody. Thank you for joining us for tonight's training on how to structure gift of equity purchase loans, right? So in order to typically, we hear this phrase being thrown around a lot. I just helped an MLO the other day with one of these types of transactions. They were basically leaving money on the table. And I'll explain that to you all as we get into the presentation on how to structure your gift of equity purchase loans. In this particular MLO transaction, a couple of the mistakes that were done is the gift was not documented on the appraisal. That's an interesting point that we have to cover. Wasn't even really properly documented on the sales contract. It was, I guess, an afterthought, and they were doing it for 3.5% of the sales price instead of having the more market value, and then giving a nice gift so that you had a low LTV. Now, one of the things I will state, the most common gift of equity transactions are FHA, but they are common also in conventional loans, and they're not common in VA loans and USDA loans, where they rarely ever happen, which I'll get into that because there's no down payment there. So, little context here, right? What is a gift of equity, right? A gift of equity, you're not transferring any funds. It's a paper transfer, I guess, of the supposed equity, some of the equity in the property, transferring it to the borrower, who should be a family member, and that equity could be used to cover down payment and closing costs. So, technically speaking, a gift of equity is the sale of a residence to a family member or someone with whom the seller has a close relationship. Although I can pretty much tell you that every single time the gift of equity is only going to be approved if it is a family member. That's the important part here. The price that's set is below market, and the difference between the actual sales price and the market value is the gift of equity. Now, this gift of equity can be used to cover the down payment and closing costs, like I just mentioned. Closing costs to include also prepaid expenses, right? Like the insurance for the first year and escrows. The gift of equity usually has to be from real person to real person, right? Can't be getting a gift of equity from an LLC. Investment property loans usually do not allow for a gift of equity. I pretty much tell you almost every time we're not going to allow for a gift of equity where there is no actual transfer of gift funds. On an investment property loan, if a gift is allowed, it has to be an actual gift of money, not equity. The borrower cannot receive any cash back due to a gift of equity. If at the end, when the dust settles, there was any money left over because maybe the expenses were understated or the gift was just more just in case, usually what happens there is that it is repaid back to the loan as principal curtailment, right? So if you got $3,000 left over in gift funds, it can be applied to the price to lower the purchase price. Now, when structuring your gift of equity transaction, especially if it's an FHA gift of equity transaction, beware of identity of interest transactions. An identity of interest transaction is any transaction where the seller is a family member, your landlord, or your employer, to name the three most common identity of interest transactions. In an FHA loan, an identity of interest transaction could result in a maximum 85% LTV. Now, I know we're not covering identity of interest transactions in this presentation, but it's an important part because it could come into play, and that's what the whole idea of structuring these transactions is all about. The identity of interest transaction limitation is waived if the borrower has been living in the property for at least 6 months. If not, go conventional. It is also waived if the borrower is buying the primary residence of the identity of interest individual. In this case, if they're buying the primary residence of their landlord, their employer, or their family member, then it would not be looked upon as like a commercial type transaction investment where the person is benefiting on something other than selling their primary residence. So beware when structuring your gift transactions who is the donor, if there's an identity of interest scenario, and if there is, what property are they buying. If it's an investment property and they're giving the gift, then that's when it would come into play that you'd want to make sure you're at 85% or lower LTV, so that you don't have any issues with all of a sudden not making the mark. So let's talk about our most common gift of equity, and I put their guidelines there for you. For those of you that are going to have a copy of this presentation, you can click on there, look at it all for yourself. I got a nice representation there of a gift letter, right, which you're going to need. FHA guidelines state that only family members may provide equity credit. That's what they like to call the gift of equity in FHA terms. Equity credit as a gift on property being sold to other family members, right? So remember, gift of equity can only come from a direct family member. Gift of equity cannot come from an employer, a landlord, or anything like that. And we're talking about grandparents, parents, brother, sister. I don't know about aunt and uncle, how deep down they go to be considered family, but we're talking about family members. The mortgagee must obtain a gift letter signed and dated by the donor and borrower that includes donor's name, address, phone number, donor's relationship to the borrower, the dollar amount of the gift, a statement that no repayment is required. The gift of equity can be used, very critical to note here, for the down payment, closing costs, prepaid items, and loan discount points without having to worry about the 6% limitation on seller contribution, and without worrying about the borrower's minimum contribution to the deal, right? You can get that gift of equity to cover everything that you need. So that's really important to note. And the great thing about the gift of equity is that you don't have to show any transfer of funds, because that's a lot of times one of the big limitations on these gifts when it's an FHA loan, is that you have to show the donor's ability to give, which would be providing their bank statement. But in this case, they're gifting the equity, whatever amount of equity they're gifting, and that's going to be pretty obviously documented by the appraisal to determine the value, and then whatever is owed, and that's the equity. So FHA, gift of equity, is the most common. Now, beware when you are helping the borrower structure their deal that just like any other gift, the gift of equity has to be documented with a gift letter. I just mentioned that there. It has to be noted clearly on the contract. And then that contract that clearly notes the gift of equity, you have to make sure that that is the contract that's given to the appraiser so that the appraiser can also note on the appraisal the gift of equity, because like any other transaction, these concessions have to be clearly documented on the contract and on the appraisal so that the underwriter can also consider them as a source of funds for the transaction. So FHA, gift of equity, the most common one. VA, gift of equity, not common. Again, I have the guidelines there so you can review them. But VA loans, just like USDA loans, do not have a down payment requirement. Hence, a gift of equity transaction is seldom occurs, because if you're buying the property from your relative, all you really need is seller contribution, right? Anywhere from 3 to 6% seller contribution to cover all your closing costs. And unless you're looking at a very, very inexpensive property, the seller contribution percentage that you're allowed to get should cover the closing costs, the prepaid expenses, and any other closing costs for the transaction. So like I mentioned, for VA loans, usually a better option just to structure the transaction with a seller credit to the borrower closing costs rather than a gift of equity. Now, USDA loans, again, I have the guidelines there for you, but just like I mentioned with VA loans, gifts of equity are rare in USDA loans where no down payment is required. Maximum seller contribution of 6% is possible for a USDA loan. So that's really where you would go for needing any funds. Remember also that we do have our down payment assistance that we can use for FHA as well as USDA loans. So we do have our 3.5% repayable and 3.5% forgivable down payment assistance that you can use for USDA loans. And in many cases, that 3.5%, if it's a good purchase price, should be able to cover your closing costs and prepaid expenses. Unless you're in an expensive insurance market like South Florida, then you got to really crunch out the numbers and make sure that you're set to go. Now, you on non-QM loans, right? That's where you really have to dig deep, because in non-QM loans, all guidelines are investor specific. And here, when I'm talking about investors, it's the companies who we sell the loans to and not the actual investor who is your borrower. So what I mean by that is that every loan option that we have out there is a different investor that we're selling the loan to. Each of those options have their own set of guidelines. So you're not going to be able to go like to the Fannie Mae guidelines or the FHA guidelines or the USDA guidelines and read them and see what they're all about. Now, keep in mind that the investors will sometimes add overlays to the guidelines. So you can start at the main guidelines and then from there check out if there's any investor overlays. Now, what I will state about non-QM loans is that gifts of equity are usually not permitted, right? They allow gifts in many cases, but one of the intertwining threads on all gifts when they are allowed in non-QM loans is that they may not be allowed to meet the reserve requirement. The reserve requirement could be 3 months per property, could be 3 months just on the subject property, it could be 6 months on the subject property, whatever it may be. It's going to vary from investor to investor, but just be aware that you can't usually use the gift funds to meet the reserve requirement, and certainly not a gift of equity if it's not allowed. So do review the non-QM guidelines to see if a gift of equity is even allowed. And again, if they do allow it, it still may require a minimum borrower funds contribution, anywhere from 5%, 10%. If it's an investment property, maybe even 20%, because it's very tough to get a gift to be accepted on an investment property, much less a gift of equity. So again, I would definitely recommend everyone to review all of your non-QM guidelines. When you get those options out, you're scouring, you have your quotes, you got 7 or 8, 10 options, all the rates look good. Now is the time when you got to break it down, look through all the options to see if there's any one that actually allows a gift of equity. Control F is how you would do it, and then search the phrase gift or search the phrase gift of equity to see if there's any options that come up. Now, I did not prepare a slide for conventional loans, but obviously conventional loans requiring a down payment will allow a gift of equity. Now, what you want to be aware of in a conventional loan, that they are going to have minimum funds contribution required from the borrower. It could be, now it depends if we're looking at home possible or home ready, which are the affordable options. When it's a single family home, those do not have any minimum cash requirement from the borrower. So if you're getting gifts for everything, it is possible for you to come in with no money out of your own pocket. But be aware, gift of equity transactions may require a certain loan to value. That's why usually we like to structure the gift of equity at a maximum 80% loan to value for your conventional loan, should it be that much of a below market purchase from the family members that you are able to build in 20% equity there. That would be the main objective there, because as you know, on the conforming loans, or conventional loans to be specific, um, LTV does matter. LTV is going to determine if you're going to have to uh, pay mortgage insurance above an 80% LTV. LTV is also going to determine, to a certain extent, the loan level price adjustment on the money, right? The lower the LTV, theoretically speaking, the cost of the money should be a little bit lower, and below a certain LTV, you may have a best case pricing scenario with the minimum type of adjustments. So it is, and also at an 80% or below LTV, there may be no funds requirement from the borrower. It could be all a gift, including down payment and closing costs and everything. So that's why it's so important on the conventional loan to keep the LTV max on a gift of equity deal at 80%. And also in an FHA deal, wouldn't be a bad idea to have that gift of equity at an 80 LT transaction at an 80% or less LTV. But on the conventional loan, it definitely makes a difference, because that means you're not going to have any mortgage insurance requirement, and also you're going to not have any minimum funds contribution requirements from the borrower, because all of the funds for the transaction could be a gift. So, to remind the important takeaways from any gift of equity transaction that you do, remember, on agency loans, there are overlays involved where, even though FHA may require it, even though this is an overlay I really haven't seen out there, but as an example, even though FHA may require a gift of equity, maybe a lender ABC may put an overlay that may say we only allow it on 1 unit properties, or we don't allow it on 2 to 4 unit properties or whatever may be the overlay that they may put. So again, once you have identified that the general guidelines do allow it, then make sure that your specific lender or investor that you're submitting that loan to doesn't have any overlay on that topic, right? So like I was mentioning though, the important points here is make sure that the gift of equity is clearly stated on the contract as a gift of equity, that the gift of equity has an amount, right? It has to be a set amount, because then that's the amount you have to look at when you're looking at, okay, my closing costs are going to be, or my down payment is going to be $20,000. My closing costs are going to be $10,000, including reserves for escrows and prepayment of the insurance. So just make sure that if it's 10 and 20 equals 30, that your gift of equity is at least $30,000. One thing I will state is that in some cases, now FHA loans rarely require a reserve, but beware if a gift of equity is possible, beware if it may be possible to use it for the reserve requirement. Because remember, many times gift funds are not usable to meet reserve requirements. So just don't get caught in that trap, and then all of a sudden think that, if you say conventional loan where DU may give you a 5-month or 3-month requirement for some sort or another, make sure that there's not an issue with using the gift of equity for the reserves. And make sure also it's on the contract, it's on the appraisal. It needs to be on those, or else you're going to get conditioned for it, and the underwriters may not be able to use it. You just can't arbitrarily put it in the application and say, we're going to get a gift of equity if it's not documented in the transaction. So certainly remember, FHA is the most popular gift of equity channel, and then I would say conventional after that. And you really don't have gift of equity options for VA and USDA, and limited gift of equity options for non-QM loans.
All right. Thank you, Jose. I do not see any questions here, but definitely a great topic to go over. Let's see here. Still no questions coming in. So remember, we do this every Tuesday, Wednesday, and Thursday evening at 7 p.m. Eastern. So we will be right back here tomorrow with a new training topic. So we'll see you tomorrow, 7 p.m. Eastern, for the next episode of the Loan Officer Training Series with the Mortgage Calculator. Have a great night, everyone.